Let's get back to our panel right now, and I'm going to bring in Steve Odland for this. We've now gotten the markets and probability story from Steve Liesman. Professor Stephen Stanley has given us the economic view as he sees it over at Santander. And let's talk about the business component, kind of where the rubber meets the road, and just how comfortable America's business community feels about the economy and whether the Fed is on the right path.
Yeah, well, it appears with the Conference Board's Consumer Confidence Index, which just came out a couple hours ago, that CEOs and consumers are aligned in their view of the present and the future situation. So both the present and the future situation confidence went up with consumers for the first time in a long time. The place where people are less confident is both in the lowest income brackets and also the youngest people. Both decline. So that's where the worry is, and it comes around jobs and wages, and that correlates with what we've seen most recently with the unemployment rate. So you see all of these factors aligning and making sense across all the measures. Most concerns still driven by inflation and interest rates, and of course the expectation that those will be coming down, but still a little nervous about what it means in the coming months.
But Professor Stephen Stanley, is there a reason why things have shifted so dramatically? It was not that long ago, in the last 12 to 24 months, when we had headlines about the Great Resignation, people leaving jobs shortly after they take one because they found a better deal somewhere else, paying them more money. All of that seemed to go away within just the last 6 to 9 months or so. How quick does the economy pivot from a narrative that bullish on jobs to one where the Fed is considering job weakness as a factor for rate cuts?
Yeah, I mean, I don't think the labor market is terribly weak, but I think what we've seen over the last year is that huge pent-up store of job openings that developed during the labor shortages during and just after the pandemic have mostly been filled. So firms were desperate to hire 2 years ago, a year ago. Now they've more or less backfilled what they needed to get to, and so we're back to a much more normal labor market situation.
What about the wage side of things, Professor Stanley? I mean, that's got to be a key to this as well.
Wages are coming off. They're still higher than they were before the pandemic, and I think the Fed would tell you they probably need to come down a little bit for them to be entirely comfortable with the inflation outlook. But they've more or less normalized.
Steve, what do you think, Liesman? I mean, I see you nodding there. There's got to be something that's going to be tangential to this story, which makes this whole thing seem relevant to everyday Americans.
Well, I wanted to answer your question about what's changed and give folks a metric by which to monitor what the Fed is thinking, what they're watching. The big story is this beverage curve. It's the unemployment rate versus vacancies. Just sort of picking up and putting some numbers on what Stephen Stanley was talking about. You were at 2 vacancies for any unemployed worker. You're now down to 1.2, and 1 is thought to be normal. So when you ask why Powell pivoted, that's a big part of it, a normalization of the relationship between vacancies and unemployment. Also, we've seen some decline in wage growth. It's still a little bit higher, but a big story, Dom, that I chronicled in the last personal income report was a decline. It was a lower growth rate of service wages. This is the reason why Powell was watching services ex housing, core services ex housing, because that was something that really is linked to the wage growth in the economy. And when we see that come down, and it was a very important part of Powell's speech that he no longer sees the job market as a source of inflation to the economy.
Now, Stephen Odland, we're going to give you the last word. Can you take us through what exactly the concerns are for business owners and consumers in America with regard to the next 6 months to a year? I say that because we do have a very important election coming up in just a few months' time, one where the economy is going to be put front and center with a few other key issues.
Yeah, you know, it's just to comment on the wages. The Conference Board's most recent survey on wage expectations for next year are that they should rise between 3.5% and 4%. That's a little surprising. You would expect with inflation starting to come down that you would see that normalize more closely to 2.5% to 3%. But clearly going into the election, households are focused on themselves. Well, how is our job? How is our credit situation? They're pretty much maxed out on their credit cards. The kitty, the savings account from the COVID savings is pretty much depleted. They're starting to feel stress, and that drives their spending and the economy. So I think we have to watch that, because I'm not sure how much more there is for them to go. So the wages then become the primary driver here, and hence the nervousness about are CEOs and companies going to dial back on jobs, or are they going to continue to hoard skill sets the way they have?
Okay. And